Hi, welcome to this video on the fundamentals of price action trading strategy. By the end of this video, you're going to find out what makes up price action trading, why price action trading is so popular, the four stages of price action, and I'll be sharing the four most important price action candlestick trading strategy. I am Machiavelli Trader. If you've not subscribed, do subscribe because I make videos, educational videos like this all the time. And if you do find this particular video educative and informative, do encourage me by giving me a thumbs up. Thank you in advance. So I will start first of all by explaining, for the sake of beginners, this video is going to be very beginner friendly. So I will start by explaining what is a candlestick. Now, this is what is a candlestick. A candlestick shows you the high, the open, the closing, and the lows of the day. It was first discovered by the Japanese rice traders hundreds of years ago, even before it became popular in the United States. Now, we have two different types of candlestick. We have the bias candlestick, which mostly is in the color white or green. And we have the seller candlestick, which you're going to see mostly in the color of red or black. Now, the difference between these two candlesticks is just their opening and their closing. You see, the seller's candlestick always open at the top and closes at the bottom, while the buyer's candlestick always open at the bottom and closes at the sell at the top. Now, when you look at the seller's candlestick, let me explain what this candlestick is telling you right here. What this candlestick is telling you is that the market opened at this range, right, at this particular point. Then the market pushed up and formed a high, right? Then the market went all the way to push price. Then sellers push price down to this low before buyers try to buy price and push it high. And at the end of the day, price closes here in favor of the sellers, giving us a red candle. In the situation of this candle, which is the buyer's candle, what actually happened was that the price opened here, then sellers pushed price down to this point and the price formed a low before buyers again took over and pushed the same candle all the way high. So when they got to this point, sellers tried to push again down because it's a battle. Each candle is a battle between sellers and buyers. So sellers tried to push price down, but unfortunately, price closed at this point, giving us a buyer's candle. So you don't know what a candle is going to be until the last second when the candle closes. It could end up turning, it can open as a as a red candle and end up closing as a green candle. So it is the last second that shows you what a candle will actually become. So now that we know what a candle is, how do we use it? Now that what brings us to what makes up a price action. You see, price action is made up of three very important parts. First is called the bullish trend, right? Now, what is a trend? A trend is nothing but the direction that the price is moving, right? You're trying to find the direction that price is moving so that you're going to take trade in that direction because that is likely going to be the least resistance direction. So what makes up a price action is three types. First, we have the bullish trend. Now, here is an example of what makes up a bullish trend. In a bullish trend, you see a group of candles extending all the way up, right, from the bottom of the chart to the top of the chart. You see these candles moving, and then there's a common characteristics to know when a chart is bullish is because the market structure. Now, what is a market structure? The market structure shows you the highs and the lows in the market. So in a bullish situation, you're going to be having higher highs, right? So you're going to have the last high, the next high is going to be higher than the last high, right? So you see price making higher highs as well as higher lows. The lows of the candles are higher than the last low. So this is a sign of a bull trend, right? So what you're seeing is price keeps going on and moving all the way up. That explains a clear bull trend. Now, the next part of what makes up a price action is called the bearish trend. Now, there's something I didn't say in this bull trend. In a bullish trend, buyers are in control. it means you're going to be looking out to buy. Buyers are in charge. Buyers are likely to going to make more money than sellers in a bull trend. So in the situation of the bearish trend, which is our next most important of what makes up price action, is the bearish trend, right? In the bearish trend, price is moving from the way up from the top of the chart, from our left top of the chart. Price is making its way down to the bottom right of our chart, right? And the most easy thing to identify this is the market structure, where you see price is making lower highs, right? So price keeps making these lower highs and keeps going down as it's going, and at the same time price keeps making lower lows as it's going, telling you that sellers are in charge. Sellers are more in the market. Sellers are selling everything that moves up. Everything that moves on up is being sold. That is what is happening when you see a bearish trend. Now, the next aspect of the market that you should familiarize yourself with when it comes to price action is called the flat trend. Now, what is a flat trend? In the situation of a flat trend, you see price is moving sideways, right? Price is neither moving up or down. Price is contained in one place. So if I should draw a box here, you see that price is neither leaving this box. Instead, price is moving sideways, right? There's confusion in the market. Price is neither moving up or down, telling you there's actually buying and selling going on, but there's no movement, which tells you there's a compression going on. And at some point, this is going to break out to either the upside or the downside. That is what a flat trend is a period of accumulation, a period whereby people are either adding to their positions or exiting their position. So a lot of things is going on here, and most traders are in equilibrium. Both buyers and sellers in this situation are in equilibrium. So now that we know what makes up price action, we're going to go forward to talk about why price action is so popular. I think the most important aspect of what makes price action more popular is the simplicity, right? It is the easiest trading strategy, in the sense that you're not going to need any indicator, and making decisions become very easy. Because if I look at this chart, I know that I won't make much money from this chart because it's sideways movement. So therefore, I am going to likely wait for a breakout. And if you go down, you see a breakout, right? You see price breaking to the upside. So price action has showed me that there's some sort of accumulation. So all I need to pay attention is the breakout of this accumulation. That's what price action. It helps me make instant decision at any time. I do not need to be confused, because the disadvantage of using so many indicators is that you get confused. Price action helps you. You do not need any extra indicator. At worst, you're going to use the exponential moving average or the moving average, but you do not need any of these indicators. You do not need MACD, you do not need RSI, you do not need all these things, because sometimes they contradict themselves. Why the MACD is telling you to sell, the RSI is telling you to buy. So it's confusing sometimes, but the price action traders believe that the human brain can make better decisions than computer. And just by looking at some set of candlesticks, they can be able to make this easy decision. The next stage we're going to go into is explaining the four stages of price action. The first stage is called the accumulation stage. Now, I'm going to go into this chart here, and I would show you what is the accumulation stage, right? So we have four important stages when it comes to price action. And these four important stages are like a cycle. They repeat themselves, right? So the first stage is called the accumulation stage. Now, how do you know an accumulation stage? An accumulation stage is a stage that takes place after a long period of a downtrend, right? This is our accumulation stage here going on. And if you find out that the accumulation stage always take a long time, right? So you see this sell-off have been going on for quite a long time. And then we have our stage one. This stage one always happen after a long sell. sell-off. So you see the stage one went up for a long time before we have the breakout to the upside, right? So this is our stage one in real sense. Here is our stage one. It is the accumulation stage that happens after a long period of sell-off in the market. The next stage is called the uptrend. Now, this is our stage two. Now, in every market, like I said, is a cycle. Price has a lifespan called a cycle. So we have the downtrend. The downtrend is going to get to a point where the sell-off is going to stop and buyers are going to come into the market. This period when the accumulation is going on is buyers are entering the market. So what we see here is that we see price we see price actually forming a new stage after the breakout. So like I said, if I draw my chart here, you have this accumulation going on, right? After this accumulation, you have a breakout, right? Where price change the market structure and start forming higher highs and higher lows, right? We started having a new market structure instead of the down ones we are having here before the change in market structure. So this accumulation that went on here, so this accumulation, let's say it has been going on all the way here. This is our accumulation stage, right? This is our stage one. So you can see this particular chart is breaking out into stage two. It's on its early stage two stage, right? So we see you just had this breakout take place that led to that stage two taking place. So our stage two is always the time where the uptrend starts, right? Is a period where the buyers are in control. Is a period where there's more buy power, more buyers than sellers in the market. So price will continue to move high while making higher lows and higher highs. With that being said, the next thing you must know is called the distribution stage, and this is called stage three. This distribution stage always go on after stage two. So when this stage two buyers, people have been buying and buying, it gets to a particular point. Buyers are no longer in the market. The market can't find buyers. Price is going to go sideways for some time, trying to look for buyers. And it's likely if there's no enough more buyers in this market, this is the distribution stage, trying to see if there is going to be buyers that will come and push price up to form a new high. But since there was no buyers in the market, price broke down the support. And since the breakdown, in stage three, you will start seeing change in market structure and price will start going down, forming lower highs as it goes. Look at it. It start forming lower highs and lower lows, taking you into the last stage, which is called the downtrend stage, right? The downtrend stage. So this is our downtrend stage, which also happened to be this stage right here. So after the downtrend stage, you're going to have another accumulation. After another accumulation, you have another uptrend. After the uptrend, you have another distribution. After distribution, you have another downtrend, and that is how the cycle goes round and round and round. So if you're able to identify this cycle and know what stage each market is at each time, you know if you are going to concentrate on buying or on selling or actually standing aside to see where the trend is going to go. So this at this point, I am going to share with you the four most important candlestick chart pattern that I know. The first one is the 3-bar reversal. Now this is a very important candlestick pattern, right? So the 3-bar reversal uh is is both bullish and bearish, right? So this is the bullish 3-bar reversal and this is the bearish 3-bar reversal. How this 3-bar reversal works is that price was on an price was in a downtrend, right? So when price hit support, it forms a bearish candle on the support, followed by a bullish candle, but the next candle completely covers the bullish candle. meaning that you are going to wait until price crosses. You're going to enter your buy right here, right? This is your buy, and you place your stop loss here, right? That's how you trade this particular candlestick. Why on the bearish aspect, price did the opposite, right? So price was moving up, right? Hit the resistance, and when it hit the resistance, it formed this bullish candle on the resistance, just below the resistance. Then it followed it by a bear candle, but the next candle completely covers the candle before the candle before it, so giving us a 3 bar reversal. So in this situation, you want to enter your trade right here, right? You want to enter your sell here and place your stop loss just here. That's how you trade the 3 bar reversal. Now, in the case of the next candle we're going to discuss is called the inside bar candle, right? So the inside bar candle is a candle that is completely engulfed by the previous candle, right? So you see this previous candle, the preceding candle before this inside bar, completely engulfing it. And how do you trade this particular candle? It's simple. In the case of a bullish inside bar, you will have price probably coming down on a downtrend, right? On a downtrend, then it hits support, right? This is your support. You wouldn't instantly want to buy support, right? You're waiting for a confirmation candle, and one of these confirmation candle is this particular candle. You have the bear candle, and then the next candle that follows it did not cross below the candle, and as well it did not cross above it. It is just contained within it. For you to take this trade, you are likely going to wait for the next candle. This becomes your signal candle. This is your signal, right? So your entry candle is going to be the candle that crosses above this mother candle. This becomes the mother bar. This one becomes the mother bar, and this becomes the inside bar, right? The inside bar. So you want a candle that will overtake. At least you will be patient for this inside bar to be crossed, right? You place your order just on the cross of this mother bar, and your stop loss just below the mother bar. That is how you trade the inside bullish bar candle. Now, how do you trade the bearish aspect? It's just the same thing. The price hits resistance, it forms a bar, and then it forms a bar that was completely engulfed by the previous bar. You just wait until price crosses this zone. You put your order right here, right? Your order is right here, and your stop loss is right here, right? That's how you trade this particular candle. Now, the next candle I'm going to talk about is the bullish engulfing, right? The bullish engulfing is also very similar to the inside bar, but the opposite of it. Instead, when price was coming down, price hit the support, right? You're going to wait for confirmation candle. You have this small red candle, but the next candle completely covers the candle of that previous candle, and it happens to be a green candle that completely covers the candle, meaning where it open, the open and the close is above the candle. The open is below the candle, the close is above the candle. So in this situation, you want to place your order right here, right? So your order will be here, your buy order will be here, and your stop loss will be right here below the candle. That is how you trade the bullish engulfing. The same thing happened with the bearish engulfing, right? So it's a seller's candle. Let's say price was moving up and it hits the resistance, right? At this point, then form a green bar, right? Then the next bar is a red bar, but the next bar completely covers the previous bar. In this situation, it tells you that the next move is going to likely be the downside. So what you're going to do is that you're going to wait for the cross. You're going to put your buy order, your sell order rather, your sell, because it's a seller's candle. You put your sell order here and your stop loss right here. That is how you trade this particular inside bearish inside bar. Now, the next bar I'm going to talk about, and it's going to be the last bar, is a very important bar. It's called the 2 bar reversal, right? And you can call it the double top or double bottom bars, right? So you see this bar In terms of the bullish bar, you have price moving down to hit support, right? So when price hits this support, it instantly form another bar that is of the same height with the previous bar. In this situation, there's a rejection. It means the selling was rejected, so it's likely the next move will be to the upside. So you place your stop loss here and place your buy order here. In the same thing happens in the situation of the bullish and the bearish two bar reversal. Price is moving up, and in this situation